Have you ever wondered how to build a resilient, high-performing investment portfolio? Well, if you have, you're in the right place. We're moving beyond the conventional reliance on a single S&P 500 fund and introducing a blueprint designed to reduce volatility and enhance performance. This blueprint consists of 5 exchange-traded funds, or ETFs, each serving a unique role in your portfolio. First, we have the Vanguard S&P 500 ETF, your core growth engine. Next, the Schwab US Dividend Equity ETF, your defensive dividend anchor. Then we introduce the Vanguard Small Cap Value ETF, or as we like to call it, the Underdog Hunter. Fourth on our list is the Vanguard FTSE Developed Markets ETF, your global competitor. Last but not least, we have the Columbia EM Core ex-China ETF, the high-conviction emerging markets growth missile. Stay tuned to learn how these 5 ETFs can work together to enhance your portfolio's performance. Diving right into it, the first ETF in our blueprint is the Vanguard S&P 500 ETF, or VO. The Vanguard S&P 500 ETF stands as a robust pillar, a core growth engine in our portfolio. It encapsulates the performance of 500 of the largest U.S. companies, mirroring the performance of the overall market. This ETF has a low cost, making it an attractive option for many investors. However, every rose has its thorn, and the thorn of VO is its concentration risk. By its nature, this ETF is heavily weighted toward a few tech giants. This means that if these tech giants stumble, the impact on your portfolio could be significant. It's like putting all your eggs in one basket, and that basket is being carried by a handful of tech behemoths. This isn't to say that VO is a bad investment, far from it. The tech giants have shown remarkable resilience and growth over the years. But it's important to be aware of the risks and not to rely solely on VO for your portfolio. It's a strong foundation, but a foundation is just the start. You need more than just a foundation to build a robust investment portfolio. While VO provides strong growth, diversification is key to mitigating its inherent concentration risk. So let's explore further and see how we can diversify and strengthen our portfolio. Next in line is the defensive anchor, the Schwab US Dividend Equity ETF, or SCHD. Now, when we talk about SCHD, we're talking stability and consistency. This ETF is like the steady drumbeat that keeps the rhythm in our investment symphony. SCHD is built around a portfolio of high-quality U.S. companies that have paid out dividends for at least 10 consecutive years. These are the tried and true, the stalwarts of the American economy. Companies that have weathered storms and come out the other side, not just standing, but thriving. They are the bedrock of this ETF, and they provide a solid, reliable return in the form of dividends. But that's not all. SCHD also serves a defensive role in our investment strategy. Think of it as the sturdy anchor that keeps a ship steady during a storm. When the market gets choppy and the high-growth stocks in our portfolio take a hit, SCHD is there to provide balance. Its emphasis on dividend-paying stocks gives it a buffer against downturns. Those dividends can be reinvested, buying more shares when prices are low, and setting the stage for greater growth when the market turns around. This strategy is not about chasing the next hot stock, but about building long-term wealth steadily and reliably. The SCHD, with its defensive nature, serves as a hedge against the high-growth but risky VO. Moving on, we have the Vanguard Small Cap Value ETF, or VBR. In the world of investing, size isn't everything. Enter VBR, an ETF that seeks out the market's hidden gems, the small-cap stocks with substantial value potential. This fund captures the so-called small cap value premium, a phenomenon where smaller, undervalued companies tend to outperform their larger counterparts over time. But with great reward often comes great risk. VBR, like the small cap sector it represents, is known for its high volatility. This means the value of the ETF can fluctuate significantly in a short period. That's the thrill of the chase when hunting for underdogs, right? Additionally, VBR has a cyclical nature, meaning it tends to perform better during periods of economic growth and can struggle during downturns. This is because smaller companies often don't have the financial reserves to weather tough economic times as well as larger corporations. However, it's important to remember that volatility is not inherently bad. In fact, it can provide opportunities for investors willing to ride out the market's ebbs and flows. And while it's cyclical, over the long term, this ETF has shown its ability to provide substantial returns, making it a valuable component of a diversified portfolio. By incorporating VBR into your investment strategy, you're not just betting on the big players, you're giving the underdogs a chance to shine, and in doing so, potentially reaping the rewards of their success. Despite its volatility, VBR adds a unique dimension to our portfolio by hunting for underdogs. Next up is our global competitor, the Vanguard FTSE Developed Markets ETF, or VEA. This ETF plays a pivotal role in our 5 ETF blueprint by providing much-needed global diversification. It allows us to venture beyond the US, harnessing the economic power of major developed markets around the globe. VEA invests in well-established economies outside the US, including the likes of Japan, the United Kingdom, Canada, and Germany, among others. These countries are home to leading corporations and industries that have proven their mettle time and again. By investing in VEA, we are effectively buying into these powerhouse economies, expanding our investment horizon and spreading risk across different geographical areas. This global exposure is key to a balanced and resilient portfolio. While the US market has been a strong performer, it's not immune to downturns. Having a stake in other developed markets provides a safety net, allowing us to weather storms that may shake the US economy. Moreover, VA offers a low expense ratio, making it a cost-effective way to tap into international markets. With over 3,000 stocks in its portfolio, it provides broad exposure to sectors such as technology, healthcare, and finance, among others. In essence, VA acts as our passport to global economic powerhouses, offering a unique blend of diversification and potential for growth. It helps us avoid over-reliance on one market, reducing concentration risk and enhancing portfolio resilience. VEA brings a global flavor to our portfolio, ensuring we're not putting all our eggs in the US market basket. Finally, we have the Colombia EM Core ex-China ETF, or XCM. This ETF is quite the maverick, as it holds a unique position in our 5 ETF blueprint. While it shares the same adventurous spirit with other emerging market ETFs, it sets itself apart by consciously steering clear of China. Now, you may be wondering, why exclude one of the world's largest economies? The answer lies in the geopolitical risks that China carries, which can introduce volatility and uncertainty into an investment portfolio. Let's dive a little deeper. XCM carefully curates a selection of companies from fast-growing emerging markets, providing the potential for impressive growth. These markets are often overlooked, yet they pack quite a punch when it comes to their growth prospects. We're talking about countries like India, Brazil, and South Africa, which are home to burgeoning industries and rapidly expanding consumer markets. What sets XCM apart from other ETFs is its strategic exclusion of China. While China undoubtedly offers enormous growth potential, it also carries distinct geopolitical risks. Tensions between China and other countries, regulatory crackdowns on certain industries, and the ever-changing political landscape can introduce unexpected volatility. By excluding China, XCM provides a smoother ride for investors, allowing them to tap into the growth potential of emerging markets without the added China risk. To sum it up, XCM is our growth missile, targeting high growth potential in emerging markets. It's an essential component of our diversified portfolio, designed to capture the thrilling opportunities of emerging markets while minimizing exposure to geopolitical risks. Having discussed each ETF, let's see how they can be combined to create a resilient, diversified portfolio. Each of these exchange-traded funds has a unique role to play in your investment portfolio. The Vanguard S&P 500 ETF, or VO, is the core growth engine, providing exposure to the largest US companies. However, it's important to remember that it carries a concentration risk, being heavily weighted toward a few tech giants. To balance this, the Schwab US Dividend Equity ETF, SD, acts as the defensive anchor. It offers stability and consistent dividends, making it a safe harbor during economic downturns. On the other hand, the Vanguard Small Cap Value ETF, VBR, is the underdog hunter. It captures the small cap value premium, providing potential for substantial returns, although it comes with its own volatility and cyclical risk. The Vanguard FTSE Developed Markets ETF, VEA, is the global competitor. It provides international exposure by investing in major developed economies outside the US, adding a layer of geographical diversification to your portfolio. Lastly, the Colombia EM Core ex-China ETF, XCM, is the growth missile. It targets fast-growing emerging markets excluding China, offering high-conviction growth potential while avoiding certain geopolitical risks. Now let's discuss how these ETFs can be allocated in your portfolio, depending on your life stage. For the aggressive young accumulator, who can afford to take on more risk for higher growth, a portfolio could be heavily weighted towards VO, VBR, and XCM. For the balanced grower, who seeks a blend of growth and stability, a more even allocation across all 5 ETFs would be appropriate. Finally, for the capital preserver, prioritizing income and stability in their retirement years, a portfolio could lean more towards CHD and VEA, with a smaller allocation to VO, VBR, and XCM. Remember, the right blend of these ETFs can create a portfolio that is balanced, resilient, and fine-tuned to your investment goals and risk tolerance.